Alright, so we're back. We're talking about the joint issuance problem. And what is that problem? Well, as accountants, our job is to take two take things and kind of allocate their costs. So sometimes things are together and it's more tricky, and sometimes they're separate. Okay, but in this case, when we're talking about creating two out of one, when they're together as one price, it gets more confusing. So let's say you go to McDonald's and you get a Big Mac and fries, and they price it two ways. One is if it's separately, you get the Big Mac for $4 and the fries for $2. And if it's the meal deal, you don't know what the individual prices are, but you know the total price is $5. Okay? So in the first case, not a big deal. You say $4 for the Big Mac, $2 for the fries. So if it's separate, you paid for them with individual prices. But now you got $5. What are you going to do? Well, there's two ways to do it. One is proportional, and the other way is incremental. And if you kind of thought for a little bit, you might come up with these. This isn't too tricky. So what are we going to do? We're going to say, well, these are still going to be $5 total. But the question is, you're the accountant, how much goes to the Big Mac? How much goes to the fry? Well, the incremental, all we do is say we know one price, and all we know is the $4. Well, we take the $4 here, and we put the remainder there. Okay? This is the known. And we plug the unknown. So in the incremental case, what GAP says is, if you only know one price, then you have to use the incremental method. So that's what you got to do. Now, in the proportional method, what happens is we have both prices, and you have to do proportional method. You got no choice. Okay? So in the proportional method, what you do is you take the proportion. So what's the proportion? Well, it's $4 over 6. And you take that times the $5. All right, and you take the 2 over the 6 times $5. Okay, so you put that all together, and it looks like I got 333, and that's one of those 333 repeatings. But we're only going to the nearest penny. And if you go to the other one, you get $1.67. The other way I like to do it is take the first one I got minus the total. So 5 minus 333 equals 167. Oops. Okay. That way you know you're allocating your full $5, but you're not subject to as many fat finger errors. Anyway, but you get the idea. This is the question. When we have one price for both in a bundle, how are we going to separate or allocate those out? Okay, so let's go back over here to our example. This is going to do the same thing, just with accounting names. All right, so here there's a joint issuance, and it's 135,000. So we're going to have to allocate that 135,000. It's 5,000 shares of common and 500 shares of preferred. Okay. We're going to do proportional method because it tells us that we have trading numbers, $14 per share on the common and $160 on the preferred. So 5,000 shares of common times 14 equals 70. 500 shares of preferred times 160 equals 80. Put them together, you got 150. So what does this 715 come from? It's just 70,000 over 150,000, and 80,000 over 150 is 8 over 15. Okay, so this is 80K over 100K, 70K over 150K over 150K equal. All right. Then where does the allocation come from? 7/15. Put that in parentheses to make sure that's order of operations is clear. And now we're multiplying times the actual proceeds of 135. See, if they would have been issued separately, it would have been a higher price. So, you get more if you buy the bundle, right? Now, I could just do 815 times 135,000, and most of the time that's going to be fine. What I found is people like save or write down part of the number, whatever. So what I would suggest is all you do here is 72,000 equals 135,000 minus 63,000. You see, you're allocating 135,000. If you've already calculated 63,000 is going to the common, then 135,000 minus the 163 must be going to preferred. Okay. And look at that. I didn't even notice. I'm so smart I already did this, but I'm so dumb I didn't notice. That's what I'm saying down here. Shorter way to the same answer. All right. And this is like really a simple, silly thing to mention, but the simpler way to do these problems, it just results in fewer errors, is to think of them like this. Take 7 times 135,000 over 15. A lot of students will try to get the 7/15 ratio and then write that down. It ends up creating a lot of errors. So just this way, if you do it this way here, 7 times 135,000 divided by 15, you just don't need to save anything in your calculator or store or write any numbers down. Okay, kind of a silly thing for me to point out, but when you're calculating and you're stressed out, it really does help. Okay, so they're issuing all this equity, preferred and common, to receive the 135,000. The journal entry, interestingly enough, this is $100 times 500 preferred shares, and this is, darn it, that button, 50 cents times 5,000 common shares. So these two you didn't even need to calculate, right? Now, the common stock, right here, this is the 63,000, and this totals to the 72,000. The tricky question, well, not the tricky question, but the most challenging question you can get is what's the amount of additional paid-in capital common stock? All right, because that requires you not only to do the allocation, but also calculate the common stock. All right, now if you get a question that asks you just for the amount of par value, you don't even need to do the allocation. All right, so incremental method. This is a little bit of a snoozer, but let's do it. The common shares are trading for $14 a share. The preferred shares have not traded for a long time. A stale price is an unreliable price. So this old market quote is unreliable, and we would not use it. And it's not unheard of. Preferred stock doesn't trade as often. Okay, so we have to allocate. This is the market value. Whoops. Shoot, sorry. We have to allocate the market value of Here's the market value of common stock, which equals 70,000. Oh, which I didn't change here. That's not good. So this should be market value of the common stock is 70,000. So this number should be 70. Oops. $77,500, and this number should be 15,000. Okay. All right, so that's the incremental method. That's the one you want to get. Although proportional is used in other places, so it's good to be familiar with it. Stock issuance for assets other than cash, you pick the most reliable fair value. Sometimes it's the common stock, and sometimes it's the other than cash asset. In this case, they issued common stock for some molds. So these are for some manufacturing process. The common shares are trading for 12. I'll tell you right now, any shares traded in an active market, so trading today, that's a great price. I'll put the smiley face on that one. That's looking good. The molds cost $130,000. Cost doesn't mean anything, especially cost to manufacture. That is not a market price. So the more clearly determinable, these are the terms that are in the authoritative literature. So, and they mean the most clearly determinable fair value, which is an exchange value. All right. If you worked on your house and spent $50,000 and you thought your house was going to go from 100 to 150, but it went from 100 to 105, the cost of it doesn't matter. What a fair value is really an exchange value. Okay, so we would pick $12 a share times 10. So it's $12 a share times the 10,000. That's where the 120 came from. So we would put that value on the equipment and likewise on the shares, which these two combined, par and additional paid in capital, are 120,000. Okay, not a tough one. More clearly determinable fair value. Now, if it says the company stock hasn't been traded in 5 years and that similar molds sell for 140,000, then that would be the fair value, whichever is more clearly determinable. All right, stock issuance costs. So, stock issuance costs, the main thing is not an expense. And generally, for transaction between the owners and the corporation, they don't result in gains and losses and revenues and expenses. Okay? They're just reductions in stockholders' equity. And this is a very important consideration because it's really about the whole perspective of financial reporting. Like net income is net income to common stockholders. We take revenue less everything that comes out of revenue except dividends, which are never an expense. So all of financial accounting is from the perspective of the stockholder. So here we have that we have a stock issuance and it's being issued for 120,000 cash. So they receive the cash, but 2% is a fee. So that's what investment bankers get. They get a cut. So what we don't do is we don't debit an expense. We send the 2% off to the investment bank, and what happens is our contributed capital is only 117,600. So stock issuance costs only result in a reduction of stockholders' equity, but not an expense.